What's up, trade pros? Welcome to another YouTube video, and I hope everyone's having a great day. And what we're going to talk about today is going to be very interesting in the options world. Hope everyone's excited because we're going to be talking about implied volatility. And we're going to be talking about how to trade with implied volatility. We're going to break down implied volatility for you guys and some trading strategies that have to do with implied volatility that you could take advantage of. Now, implied volatility in the options world is a very tricky beast to understand. It's a variable nonetheless, like a lot of the other things in the options world, like the Greeks. It's not necessarily a Greek, but it's a variable that everyone should be aware of because it has the ability to make or break your trade. Now, having said that, I hope you guys are now excited for this video where we unveil a lot of IV secrets for you guys and break down a few of our favorite strategies that take advantage of understanding how IV works. So IV, short for implied volatility. Now that we're all settled, I want you guys to smash that subscribe button, hit that like button, and drop a comment down below about Greeks, about variables, and what you guys think about implied volatility. Do you guys use implied volatility a lot? Do you kind of neglect it? Have you been burned by it? Let us know. Let us know what else you want to see here. And we're just going to get started with this intro and dive right into this video. So now that we talked about implied volatility a lot, we should understand what it is first. Now, implied volatility, you're going to hear the word expectations a lot. So it is the expected volatility of an option, right, from an underlying move. Now, implied volatility is the expected volatility in the future, right, at some point of an options move. So it's very driven by supply and demand. Now, if there's a lot of demand, for example, for an option, right, a specific option at a specific strike in price, whatever it is, or just a general underlying stock. If there's a lot of demand, a lot of expected movement, and a lot of hype around that, the implied volatility is going to increase, and so will the price of that option, right? So it's an expected move, right? So if there's high expectations, right, there's expected demand to increase, or if demand does start to increase rapidly, you're going to see the increase in implied volatility, whether it's to the upside or downside, whether it's to the call side or the put side. Right? A large expected move in an underlying is going to increase that implied volatility. Now, conversely, if the demand drops, right, then the implied volatility is going to drop in that name, which means that the price of the option is going to drop as well. So implied volatility, even if the stock moves in the direction that you assume it will move, right? Let's say you think it's going to go up and you buy some calls. Right? If the implied volatility was at a peak when you bought those calls and the implied volatility drops, right, but the stock continues to rise, you're going to see it lose value. That's how powerful implied volatility is, and that's why you should understand exactly how to use it. So the supply and demand, right, of the actual underlying as well as the option will dictate the potential implied volatility. So uncertainty, right, brings out expectations. So uncertain events turn into expected increases in implied volatility. For example, earnings. Leading into an earnings report, you may see implied volatility increase. A big news drop, right? When we saw GME and AMC, right, their implied volatility was 600-700%. This was because there was increased demand and hype around it. A stock split, right? Like NVIDIA, the inclusion of a stock on the S&P 500 like Moderna. So when the expected volatility increases, you're going to see the increase in implied volatility based on some kind of news event. Also in Fed events as well. So another thing to note is that strikes nearest to the money, so at the money, right around the money, which is the current price of the option, the implied volatility used with a Greek called Vega, right? The Vega kind of measures that, is going to affect the strikes at the money the most. And deep in the money and deep out the money are going to be least affected by that implied volatility. So with implied volatility, there are certain ways to look at it and trade it, right? Which we're going to just jump onto the screen and show you guys instead of just talking to you guys like this. So another thing to note before we do that is that each individual stock has its own kind of a range of implied volatility, right? Some stocks naturally have a high IV. Some stocks or indices naturally have a low IV, and that's based usually on the expected beta move, right? The movement, the eradication, I guess, of the actual underlying itself. So what I mean by that is some things move more frantically than others, meaning that they're going to have implied volatility, right? There's more uncertainty in them. Some stocks swing 10, 15% a day. They're going to have high implied volatility. For example, the SPY index, right, the ETF, has an implied volatility IV between 12 and like 17 on average %, while something like Tesla may have IV on average about 50, 70%. So you can see the big discrepancies. It's also very important to understand what the average implied volatility for a name might be, right? And we're gonna go over there on the screen and check that out, and we're gonna identify a lot of different strategies and how to use them and how to look at implied volatility. Where do you find it? So let's go ahead and jump onto the screen and we'll see you guys there.
All right, traders, we're back on the screens here, and I want to show you guys more implied volatility. We're going to talk implied volatility, we're going to talk interactive brokers, we're going to talk strategies, we're going to break everything down here. So the thing with implied volatility is that every stock has, every option, every underlying has just a different implied volatility on average, right? And this is the options chain. This is the options chain on interactive brokers. And you can see right here, I got the triple Qs up, the tomorrow's expiry, September 30th. And you can see the implied volatility in the corner. I don't know if you can see it, but it's very small. It's around 25.1%, right? And as we move along, we're going to see the average implied volatility, right, change slightly. But overall, it's very, very similar, right? If we just change the actual expiries, you can see it's 26.4, sorry. If we go to the SPY, for example, and we look at the implied volatility on average here on the SPY today, right, today, we're going to see that it is around 18.1. Now, if we go to, let's say, tomorrow's expiry, like we looked at on the Qs, it's around 20%. So this is on average elevated, right? It's a little elevated for what the SPY normally does. So with interactive brokers, there's an option here. If we go into new window, you guys can see, let me just go like this. We go into new window and we go into our options analysis and we can look at the volatility skew, right? You can look at multi-expiry skew. You can look at time-lapse skew. You can look at implied volatility by expiry, historic volatility, right? The historic volatility isn't going to really tell us too much, but if we open this up, right, we can play with a bunch of these. Let's start with this one first. If we open it up and we look at the SPY, for example. So the SPY, right, IV is the white line, right? On average, you're getting the IV. You can see this is from the month of August. Let's go 1 year, right? From a 1 year period on average, you can see that the SPY is around 15-ish%, right? If we just grab the middle of this. So we can look at the historic volatility, but we can look at the implied volatility rather than the 30 days. So if we're looking at this, the white line is going to be the implied volatility. You can understand it's around 15%. So with that being said, you can see there is elevated periods of implied volatility. And as you may have it, this probably looks a lot like the VIX, right? The VIX with the SPY, that's a good gauge. Now, if we look at other names, you'll see that their implied volatilities are much different. So you can see Tesla on average, right, is going to be much higher. Over the past bit, Tesla has dropped in implied volatility, but it's still relatively high. You can say somewhere that it's at 50, and right now it's the implied volatility for Tesla is low. So another name, maybe Roku, right? Roku's implied volatility is much higher than that of the SPY. Now, if we look at more of a sleepier name, right, maybe Walmart or something like that, you can see its implied volatility is very, very similar to that of the SPY. Now, if we go into XLU, this is the utilities ETF, and again, it's on average probably a little less than the SPY. So with this little instrument, you can find what the average volatility is going to be, what the average implied volatility is, and based on that, you can gauge, oh, these are periods of high volatility, these are periods of low volatility. Now, like I said, implied volatility is going to be based on the supply and demand, right? So there's multiple different scenarios in which that implied volatility is going to increase or decrease based on uncertain events. So that means that if we can catch a move where implied volatility is expected to increase, we're going to have a potential profit. Now, if you are a buyer, the idea is you want to buy when implied volatility is low. If you are a seller of options, whether you sell puts or calls, you want to sell when implied volatility is high. So why don't we break down a few different examples here? and identify what the scenario might be. So if we push this aside, let's just grab this, move it aside. And there are a few main strategies that we want to talk about. So those strategies involve selling and buying, right, when implied volatility is low or high, but they require certain events, right? It's not as easy as just, okay, implied volatility is low, I must buy. So when it increases, then, right, we're going to make money. It's not that simple. So the strategies that we're going to talk about involve earnings plays, right? And around potential news, right? So let's use the Fed event as the potential news. So right around potential news, you start to see an increase in IV. Now, understanding which direction the stock is going to move, it's going to be a little more difficult. So we can't necessarily time it that well. However, if we take a stock, for example, right? Let's see what the last earnings report on MU was, for example, because MU came out yesterday. The earnings report on MU came out yesterday. So if we grab this and we turn this into MU, right? And oh wow, MU actually had an interesting pop today. But since the market's down, it's going to be very hard for that to come to fruition. So MU, right? It had an earnings day yesterday. They reported a good beat, but why did this thing gap lower? It's because the forward guidance was pretty bad. So why don't we look at MU in terms of historic volatility? Now, you can see what happens leading up to earnings. Why don't we go 2 months out? So 2 months out of earnings, right? Typically, I like to look at a 45-day period. You can see, so now it's the end of September, so that means end of August, end of June, for example. So here we have the beginning of August, which is somewhat 2 months, and you can see the implied volatility has a rate of 32%, right? We climb all the way up to 42%, right? But in that time period, right, from August 3rd, let's see where August 3rd is. Can we identify August 3rd? Let's use a brush. August 3rd. So August 3rd is right here, this candle right here. And you can see that we were at, let's call it 79.50. 79.50, and then at one point we were down at 69, right? We were down at 69.00. So a $10 drop, right? Around a $10 drop. Now, we don't know if we should have bought puts or we should have bought calls. If we got calls, it could have gotten extinguished, right? But on the other hand, if we bought puts, it would have been great. But we don't know. We want to play it on implied volatility coming into earnings. So we want to make sure that no matter what happens, we know that the implied volatility is going to go up. In this case, it went up 10%, which is pretty good. But no matter what happens, we want to make sure that we make some money on this. So leading into an earnings period, we do something that's called a straddle or a strangle, where we buy a call and we buy a put, right? In the hopes that the IV increases and one of these gains more value than the other one loses. Now, if IV increases, the one that loses, the actual drop in its value is going to be somewhat offset by the increase in implied volatility. Now, if the increase in implied volatility is super drastic, right, then you're not necessarily going to witness that big of a drop-off. So back in the day, back in August, if we, let's say, bought a monthly for October, right? So if we bought a strangle or a straddle, right, where we would buy one of the calls, like for example, we buy the 80 call and then we buy the 72 or 75 put, which is going to be a straddle in that sense. We're gonna pay a debit for both of those, right? But the idea is you see right where the implied volatility spikes and drops off, right? This implied volatility spike is probably due to other circumstances other than just the increase in IV in terms of the uncertain event. But when that spike happens, that's when the options are going to be the most profitable. And that's where we look to dump them in this earnings event. Now you can see, even right before the earnings event, the IV was relatively high, right? It was about 39%. And right when earnings hit, we dropped a drastic amount. Even if you were right on direction, you're going to get slapped in the face by this drop in IV, right? It happens right away. Why is that? Because the earnings report is built up on uncertainty, right? So once that uncertainty has passed, then there's no uncertainty. So that means that there's no expectation of increased volatility in the future, meaning that the implied volatility is going to tumble. So that is where we want to get out. Right after the earnings report, IV tends to drop, right? IV tends to tumble, and we clear those uncertain expectations, and the value of the options drop off. That's why a lot of people like to buy more time when trading into and after earnings reports. I suggest getting out of the position right before, right when this IV increases and spikes like that. That is when you want to get out of the position for the maximum potential gain right before the earnings scenario. So you want to moderate the IV on an option when you're in the earnings trade. Now there's the opposite. When you are looking for high IV opportunities, what you're going to be doing is you're going to be selling your calls and puts, right? You're going to be shorting a strangle or a straddle. Now, what that means is you're going to create a credit, right? You're going to create a credit into your account. And when the IV drops off, right, that is when sellers make their money, right? Because the option just evaporates into nothingness. As a seller, you want the option to go to zero as fast as possible, right? You want to take home the money and just leave the option to expire to zero. That's what sellers want to do. And on these IV drops, right, that's exactly what happens. So typically, sellers look to sell the option when IV is pretty high. So that's right before the earnings report, because they know right after IV is going to drop off and it's going to fumble. So just as it happened here. And then even in other circumstances, for example, Fed events, right, after the Fed event concludes, the IV is spiked. And what you do is typically sell a straddle to take advantage of that. One side of the position wins big, the other side might lose small. But the idea is you're selling it so that you can take advantage of the big drop in IV. So understanding IV and its many strategies will really help you understand what option strategies to trade, when to trade them, when not to trade them. Because when IV is super high and you're looking to buy an option, even for a day trade, you may be a little discouraged, and rightfully so, because that option might just evaporate in value. So just keep that in mind going forward. Even if you're day trading, if you see an opportunity, even like Nvidia, GME, AMC, right? They were hyped up. They created a lot of opportunity. They were extremely high IV, but when that dust settled and the IV dropped, even if it did start going in your direction, you were going to get creamed on the position. So keep that in mind. If you want more tips and tricks like these, just drop a comment down below and we'll provide more videos and beginner videos like these to help you understand the options variables. So I really hope you guys enjoyed this video, and I want you guys to smash that like button if you did, drop a comment if you did, and hit that subscribe button to help support us. So this is Victoria from TRADEPRO Academy, and we will chat soon.